module of the Profile Trading Development Pathway, where we are systematically, module by module, helping you build toward trading skill and consistency by learning how to profile, which is helping you arrange market information so that you can make better decisions and ultimately take more profits. Now, if you've not already done so, I encourage you to make sure that you're well aware of the orientation materials and videos that we have on the website to prep you to the methodology behind the pathway and how that works and how we see that in day-to-day plans. In this module, we're talking about module 4 of 16, monitoring and executing based on price and value placement. Now, like all other modules, we start with a challenge that is common to traders. If you've ever had this question, know that you got company. But the question is, which prices are the best to be active at? And do I need to have a chart up at all times? And what prices should I avoid? Seems reasonable enough. Fortunately, there's an auction principle that helps us give some understanding. One is that price is important. Anybody who says that price is not important is, price is the most important thing in an auction. But it's not as important as volume spent at a specific price. So what we find is that while price is important, there are some prices who are more important than others. And the accumulation of volume traded at a given price defines the relative meaning of that price to the auction. And if you're a trader who doesn't monitor price in relationship to value, which we'll define here in a second, you have a heightened probability of poor trade location and being trapped. And that's something that we want to avoid. So at the end of this module, the outcome is that you're going to be able to observe value across multiple time frames and discern the strength of each value area or node, giving clarity to areas to be active and areas to avoid based on your chosen way to express that relationship. Now, I'd say the godfather of auction theory, although Pete Stottlemyre did the initial work at the CBOT, Jim really made this accessible to the masses with his books. Highly recommend them. But he says that trade location is the best form of risk management. Okay, yeah, great, Jim, thanks. That's, what does he mean by that? He means like, if I pick a better place to put a trade on, that's the best thing that I can do to help get good risk. Years ago, I actually was a record producer and helped bands record albums. And one of the things that we did, especially when there's all kinds of software and different ways that we could manipulate the audio, an audio producer that I was learning from, he said, look, like we spend all kinds of time trying to make sure that we record the cleanest sound first. Then we do all of the effects in post-production. We don't have to use as many effects. It's not as much work on the back end if we just wait for the good sound first and get a good take. Similarly, around trade location, if I know a good spot, and knowing that not every spot is good to do business in the auction, if I pick better spots, I'm already doing better with risk. So to do that, and something to think about as we work through this module, is that positioning ourselves with respect to value, in quotes, gives us good trade location. So if trade location is the best form of risk management, positioning ourselves with respect to value gives us that. Okay, so like what do we mean by value? And you'll hear us talk about value all the time. If you've been around me for any period of time or our community, you hear us talk about value, and like what exactly do we mean by that? Well, just like any auction where value can be defined, good trade location is found selling above and buying below value, right? How do I get a good deal? Well, I bought something below value. How do I get a good deal selling something? I sold it above value, okay? Well, how do we define it in our context? So we use the term point of control to define value. When we talk about point of control, that's what we mean. We mean value. And what this is this is the most traded price by volume in a session, and it represents an accumulation of both buyers and sellers around a fair price. So think about like a housing market, and you put your house up and get it appraised, and they come back with a number that says this is what your house is worth. Where does that number come from? It comes from other homes of similar specs that have traded at that price in recent memory. Okay, that's value and defined in that time frame. So continuous auctions move from value to value as we progress through the various auction behavioral phases, like we talk about in Module 1. Just like in a housing auction, there can be the value for somebody who flips houses versus the value for somebody who's going to be in a house for 20 years. Those can be different fields of value. Same thing with the tradable market. So the task for you is to define value for the time frame that you seek to be active. So what value references you're going to look at are going to be predicated on where you want to be active. Are you more a flipper? Or are you more of somebody who's going to be in it for a decent period of time? The references of value will be different. Now, what does this look like exactly? So here on a TPO chart, we can see pretty clearly on a full completed session, it's going to be this most traded price. Now, I have TPO charts, but I have them actually colored by volume. So that's why sometimes you can actually have the TPO point of control here, but the volume point of control is different because we use volume instead of time to denote value. Most often, they're in line, okay? But that is what we mean by a reference of value. And then if I look across multiple sessions, if I combine all of these sessions, I get value here. So I have value for multiple sessions that's down here at 11,321, but I had value on this session that was 11,531. Okay, so when I'm coming into a session, the first reference of value to the auction, am I above it or below it for good trade location, is the prior day's volume point of control. And then as the session progresses, the auction will either accept prior value, which we call development, or attempt price discovery, and the development of new value, distribution. So development, consolidation, distribution, trending. Development, sideways action, distributing, directional activity. Okay, we talk about that in Module 1. At the same time, the auction is aware of value on other time frames. So you have participants, just like in a housing auction, right? You have people bidding on a house. Some people are going to bid on the house to hold it for 3 months, do some fixing to it, and then flip it back out on the market. Some people are competing on that house because they're going to live in it for a long time. The motivation of what price they get relative to the value in the near term is dictated by the time frame that they want to be active. And what we find is that there's an ebb and flow between value references of various time frames as there are participants with different pockets. So if I have all of the lots of flippers in an area, house flippers competing for prices all the time for houses, it can actually cause a lot of tight trade around a specific. You're not going to get price to move much from value. When I have people who don't really care because they're like, hey, I just want this house, and it's I can finance it for next to nothing, so I'm gonna be in this house for 30 years. I'll more than make up for it. You can have more price movement when you have somebody who's got a longer view at sway. So again, depending on what type of trader you are, if you're trading inside of a single session, this is you're going to look at, okay, what was the prior day's value, and then where's value here? So that's actually a little bit of distribution. But somebody who's more long-term is thinking, hey, I really just want to know where I am relative to this price. And then as you go about in the auction, one of the key questions to keep coming back to and always check yourself on, you find as we go through the pathway, we have lots of questions, always as self-checks for yourself to keep you out of trouble. And that question is value following price, or is price returning to value? Okay, so is value following price, or is price returning to value? What does this mean? So value is a fair price. It's the price that you can get both buyers and sellers to be active at. But over time, new information starts to shift where auction participants believe that value resides, and they will attempt away from prior value in search of new value. And when price moves away from value, we call this price discovery, prior value is left behind. And when an auction is attempting away from prior value, this is what we call initiating activity. And if value follows price, price continues directionally. So, how would value follow price? Well, if value is defined as accumulation of buyers and sellers at a price, what would we need to see? We would need to see a buildup in the profile of buyers and sellers in the direction of those directional prices. And that can help facilitate further directional trade. If price returns to that prior value, which is responsive activity, when price returns to value, price discovery is over. So again, is the question we're always asking, if we see something moving directionally, is value following that price? If not, is price returning to value, and what is that value reference? So when you're thinking about how you're going to position this, so you think, if I want to go with price discovery, what do I want the price to value relationship to look like? And if I want to fade price discovery, I want to take the counter position, what do I want the price to value relationship to look like? Well, it can help by looking at a couple different value references and have these in your toolkit. So one is that prior session volume point of control. So when you come in each session, that's your first reference of value to know, hey, is today's auction attempting above value or below value? It's giving you a hint to directional attempt and discovery. And then as the session keeps going, where is the developing point of control, the developing value for the day? And then where is the 5-day volume point of control, the most traded price for the last calendar week, or the 20-day volume point of control, that's the most traded price for the last calendar month, prior monthly volume points of control, prior weekly points of control. So, and that's seen. So here, if I'm trading on this day, that's the developing point of control. I came in on that day and that was the most traded price of the prior session. So you can see that this day they opened above prior value and were able to sustain above prior value. And those are two references of value. Now, on a chart like this gives me the ability to see a number of different time frames of value. Here is that rolling 5-session value reference. That's the most traded price there. And then there's these red profiles are each week, and that most traded price is in agreement there. The most traded price from the prior day was here. The developing point of control is here. And then the most traded price for the last week is here. That's also the most traded price for the last month, which is this profile. So, in this thing, I'm in agreement. I'm in agreement with price for the last week, the current week. I'm above last week's value and I'm above last month's value. And you'll see that there's a number of different arrangements. Here's another one where, I'm in agreement with weekly value above monthly value. Here, these are daily bars. And over on the right, I have a rolling monthly value with the most traded price here. I have the most traded price of this week. Here's the volume point of control of that week. Here's the most traded price of this calendar month. This is a rolling 30 days. Here's the most traded price for 6 months, all the way down here. Those are all references of value to the auction, and you'll find at different times those prices come in play. So then, okay, we have these references of value, but let's talk about expected value behavior, or expected versus unexpected behavior. So moves, like we talked about in module 1, begin from value and fail away from value. So when the auction fails directionally and returns to value, we expect price to slow as the auction re-engages prior participants. If price slices through a value reference, this is a clue to larger time frame value player participation. That would be an unexpected behavior. And when a value reference does not hold, we need to go to a higher time frame. The translation is that the higher time frame value is in control. So if I'm trading and I'm looking at yesterday's value and I come back towards that value and slice through that and don't even stop, then I'd go, okay, well, where's value for the last week? Where's value for the last month? Those could be references in control. Because the more volume included in a high volume zone, a high value zone, the bigger the magnet if price fails to continue away from value, and the more likely it is to hold the auction when you re-enter. Okay, so auctions move from value and they fail away from value. And when they fail away from value, they come back to value. And value should hold the auction unless there's a higher view of value in play, and then we'll go to that value reference. So as we translate this into action, the question for yourself is, am I a better trader at value, looking for the move, or away from value and looking for it to come back? And we find two central relations. We find opportunity in two central relationships when price and value converge and when price and value diverge. Those are two different opportunities: price and value convergence and price and value divergence. So let's talk about price and value convergence first. Okay, so back to this example. Here I have several sessions of the Russell, and if I actually merge the prior 4 sessions, I can see a significant reference of value to the auction. It's also shown here on this volume point of control. And then I have this session. Okay, so here I have an attempted move away from value. It's starting at value. So the price and value convergence opportunity is that when price and value agree, we are trading around value. This is the rest or development before a directional move. So we know a move's coming. And in fact, the more agreement of value across multiple time frame references, the more important a level and the larger a move when it occurs. So your job is to prepare for a larger move away from these areas if trading inside them. And they can be substantial, like this move in lumber. Now, in this case, the development of the larger node took about 9 months in total before the really big move took place. Here in this case, we had a couple weeks of development. You can see this key node here is where the beginning of this new move started. Substantial moves start from the convergence of price and values, like this one. Here it completed with a trend day higher away from this value. Look how this auction continued from then. Very, very significant move. Now, there's great opportunity in a move away from value, and there's also a trap. And I want to help you be aware of the trap. And the trap is this: you don't know when the break will occur. You just know it will at some time. And trying to anticipate the break can lead to traps. Being too eager to trade can lead to many false starts, or even worse, pick the wrong side of the breakout, because you just know a move's coming. You don't know which side. In some sense, there's some clues as to which side, but often there's not. So you don't know until it happens. So entering early on false breaks and continually getting stopped out will damage your account and your confidence. So here's how you avoid that trap. One is, knowing the context of the posture, which you talk about in module 11, like how long have we been in that posture, can help set your expectations and avoid the chop. Also, open types can help predict likely day types, which we talk about in module 16. If I have an open drive away from a area of value, an open drive that starts at value, that's likely to lead to a further directional day away from value, and I can go with that. And you need the skill of being able to pre-think how the auction would need to behave to give you confidence in the break from value. So like we talked about in module 3, there needs to be acceptance. And then in module 8, we talk about order flow. Like there needs to be conviction in the order flow in the direction away from value. And always, if you're going to take the trade, you're going to have a target in mind. An easy way to develop the target is to say, well, what was the size of the area of value that I'm coming from? And that's my initial target added to the break. Watch for impulsive behavior away from value, and then allow others to establish the move and confirm with acceptance before joining. So, when all these false breaks, watch somebody try to break it. Don't be the one who tries to front run it. Let someone else break it, and then see if that can hold on a smaller time frame, like we talk about in module 14, and then join the break on weak pullbacks. So weak counter activity kind of back toward value, but it's not very strong. Mark the site of origination as the key reference and defend that site. So like here on this break here, where is this thing really get going? Well, I mean, it opens here, tests below value, drives above it. Okay, so I have a couple different options. For the full day, I could absolutely do this one tick below the low. I bet if I went and looked at this at a 5-minute, I could find something even tighter right around this area of the value that I could lean into, but at least on a daytime, I would lean there. And this, if you'll notice, at the end of the day, value on the day is up here. Divergence away from the prior day, that's acceptance and would suggest continuation the next session. Now, that's price and value convergence. Now, the flip side of that is price and value divergence. So this is when price and value are not in agreement, but disconnected from each other. And this happens because during impulsive events, price becomes disconnected from value. When you have strong price discovery, price moves first, value's got to catch up. And it's a great time when you see price moving away from value and you're in the position, that's a great time to look for the exit. You've got good trade location to exit, or look for potential responsive entries to trade back to prior value references. Because if the auction fails to migrate value or accept those prices, price is likely to return to value. So if the price discovery does fail, recent value becomes a fantastic target for the same session or subsequent sessions. So remember this move from value? Look where we were some months later. And this is obviously on a long-term basis. Or this move, okay? Look where we were a couple days later. Look how we came back to this reference almost to the tick. All right, so there's great opportunity in being away from value, but there's also a trap. And here's the trap here. So you can see the trend and the disconnect from value. So you decide to take the counter trade and the move is not over yet. That's like stepping in front of a train. You can see that participants are getting ahead of themselves in the near term if value can't follow price, but early faders beware. Price value divergence was created by impulsive initiating behavior. So be careful to take the counter position. You can avoid the trap by one, knowing the context of the posture. Like if we started at a balanced posture and we've had 1 day of a move away from that, and now we're price above 5-day equal to the 20-day, that's not a scenario that's likely going to fade. So let that thing shift in posture before you really want to take some type of big fade to that. Also, open types can help predict likely day types. So lean on day types if you find them that go in the direction that you want to go. Pre-think, just like with the move away from value, pre-think how the auction would need to behave to give you confidence in the return to value, either seen through rejection of new value, also through order flow. Have a target in mind. It's a little bit easier because you're typically targeting a specific value reference. Watch for impulsive behavior back toward value, and then allow somebody else to stick their neck out first to establish the move and confirm with acceptance before joining. Join the return on strong counter behavior. Now, to just kind of walk through this step by step, here is the Russell, and I've actually have several days of balance before. You can see the big node here, and we had a trend day, and then a gap, and then another trend day, and now we're set to gap again. So we've had 3 days of movement away from value. And here's the prior day's value, here's a prior day value, here's that multi-session value, and we're trading above that. So is that great location to go long? Maybe, but where's the risk to that? What would need to happen? You would need to have further confirmation of value in that direction. Is it a great place to go short? Well, I can see the divergence, but I don't see anybody selling this thing yet. So let's kind of walk through this day in a 30 minute by 30 minute pace to just see how this develops. This is right before the open. So here's A period right into B period. And what do I have? I have an open here. In fact, I had the most traded price for this session, and I opened above it and traded back in this vicinity, back toward VWAP, back toward prior value, and I'm into B period. That's looking like it has some potential. I've got some negative order flow on the day, although volume is pretty light just yet. But if this can sustain, then it could take me at least back to this value reference, if not start me on a direction much further. Okay, let's see what happens 30 minutes later. Okay, we hold the gap. Here's the gap. Buyers step in, the order flow number changes, and we come back to further affirm value for the day, which is where? Above the prior day's value. So we're accepting value higher. Okay, 30 more minutes in, and we have extended IB high. So with our IB extension stats, we know that the probability now of taking out the low is 30%. But I'm also now trading above value from today and the prior day. So do I want to go with this? Or am I thinking, hey, what if I could get up here? I'm above today's value, I'm above here. That would be a great location to get out. Maybe that'd be a great opportunity to get in. Okay, we spend more time balancing right up to lunch, over lunch, and then right after lunch, we're breaking higher. Now, we're further affirming value right here in the middle. We're now above value. Now, this is an impulsive move, good IB extension, but notice how we're getting a taper in the profile as we move higher. I'm thinking, man, I could try to fade that, and then where would my target be? My target would be right here for today from up here, but I need to find sellers, somebody interested in counter activity back in that direction, where it's not going to work. This is impulsive activity higher. Now, for me, given where we are above all those value references, I'm not interested in being long. So this is one of those situations where I'm not interested in being long, but I'm not interested in selling this either, because I just don't see any sellers. In fact, I'm seeing things like we talk about this in module 13, but I'm seeing single prints, very impulsive. I've also got the gap. I've got this naked reference down. I've got lots of references below, but I need some sellers. I need something to show me that we can turn this thing around. Okay, now I'm trying to migrate value higher. And how do I know that? Because I'm developing value around this node, and now I'm higher still. But notice that as I'm moving higher, I'm getting fewer contracts, right? So here's 4,800. I have, about 12,000 down here. I'm running out of participants as this auction moves higher. Whoop, what just happened? I'm all of a sudden back here. Okay, well, let's explode this and look at this on a, if we break out the 30-minute period, what do we see? Well, we saw here in K period, and this likely was some type of news event that caused this. Why do I know it's a news event? Because we talked about a return to a value reference. So the target on the short, and where would the short be? Likely when you came back through this area of volume here, this creates excess, which we talk about in module 6, that we can lean on. That's sellers. So as I went up there, I couldn't find any more participants. I had 8 contracts at the top trade back through an area of value, and below that, I'm accepting back in the direction of prior value. But when I came back to this reference, the auction didn't hold. It sliced straight through it. So that's what tells me it's a news event. And I got to be thinking about larger references or further references than maybe what I would expect. Maybe this one down here or so forth. And we actually clean up these singles down here. So we cleaned up all those singles. We got back to the current day's value. We cleaned up the prior day's value. Very impulsive. And at the end of the day, we actually migrate value lower, further accepting those sellers. So this absolutely shuts it off. So in terms of our behavior, we found counter behavior now that shuts off the directional auction. And this is now going to take this auction into a rest phase. This is counter activity on a day time frame. So then for the next day as I plan, I would expect this to start trading more sideways and have difficulty getting above these highs. So again, the question that you always ask yourself is, where can I get trapped? I mean, hopefully hopefully you know enough that when you see a move and you can see a trend, a move away from value, you know, hey, if I go with this when it's already moved a long way, you know, I could get trapped away from value. But what you may be trying to do is trying to counter it too quickly and getting trapped, or you're trying to be too eager to catch the move before it starts and you're getting trapped. Those are the more common ones for those who use the profile. Now, some further refinement for how we use this with our anchor trades. You know, should I go with or should I fade? Well, moves in, so for the IB go with, moves initiating from value, price to value convergence are the ones to go with. And auctions disconnected from value, where there's price to value divergence, those are the ones to fade. If I'm looking at IB go with and my entry is established at the IB high or low, that means I'm likely entering away from developing value and so for the trade to be successful, I want value to shift and I want acceptance in that direction. I want value to follow price. Otherwise, I can get trapped trying to get away from value. If my entry is established favorably relative to value, like I got to pull back into the IB, and I'm now doing the buy above, sell below to developing value, I believe the participants are getting trapped trying to get away from value. So it'd be easier if I draw this, but the idea is that, you know, if I've got an IB and I take out IB high and my value is here, that if I have rotations back down here and I'm going to look for the long, I believe that anybody who's going to try to go short down here is getting trapped trying to get away from value, and we're going to head back to value. And I know that because of the day type. Like if I'm rotating all the way back down there below value, then that's likely a rotational day, and we've already extended the IB high, so it's unlikely that we're going to take out the other side. I can lean on that. Now, if the extension fade is in play when there's evidence that the price to value is divergent and we are finding failure as the value is not following price, so we believe that price will return to value. But what we need to see is we need to see strong counter-directional order flow along with the day type to have confidence for the return to value. What does that mean? We can't be in a trend day. We can't be in a double distribution trend day. We don't want to be in like a neutral extreme day. We don't want to be in strong directional days. The fade is not going to work. We want normal days, normal variation days. Neutral center days are great, but outside of that, it's difficult. Okay, let's talk through some cases here just to kind of coalesce all of this. So let's say it's 1 p.m. Eastern. The NASDAQ is trading 10 points above an IB range that's 40 points wide. So far, it's a normal higher day type. So we've taken out IB high. The current developing volume point control is 30 points below the current price. What is the trade? And where are you most likely to get trapped? Well, for me, when I look at that and I go, okay, if it's 40 points wide and I've got 30 points below the current price, that's a great target. And it's after 1 p.m. It's kind of the time that I would look to be fading, and it's a normal higher day. So assuming I'm not making new highs, I would be looking to fade this. And that's where I would most likely get trapped, is if I didn't have confirmation in the order flow, if I can't get back inside the IB. So, you know, I need to be back in that IB shortly. If it's after 1 p.m. and I'm not back in the IB, I could be looking at a trend situation that can sneak up on you. So you want to be close to that IB, want to be looking for moves back to that. Otherwise, I could get trapped trying to fade it because I'm in proximity and get pushed away. So that's how I can avoid getting trapped in that sense. This one, it's 10:30 a.m. on an FOMC day. Price is rotating around the current developing volume point of control. So far, it's a non-trend day. The current volume point of control is the volume point of control for the past 5 sessions. Where is the trade? Where are you most likely to get trapped? And how can you avoid getting trapped? Well, where is the trade? The trade is the break from value. You've obviously been balancing for some time. You're developing. There's going to be a move likely caused by whatever's released with the FOMC. But where are you most likely to get trapped? Being too eager to front run the move. So how can you avoid getting trapped? I personally love using like a binary second move, meaning if we haven't taken out the IB, let them take out one side first. And then I want to see if they can hold outside of that. And let's see if they can hold outside of that for like a half an hour. And if they can't, and they come back through the IB and take out the other side, they've trapped some early people trying to guess the move, and they're more likely to go the second direction. That's the one that I love. It's 2:30 p.m. Eastern in the ES. Price is trending higher in a trend day. The current developing volume point of control is 25 points lower. What are you looking for from a price value relationship that would provide or negate opportunity? Where are you most likely to get trapped? So this, notice that it's a trend day. So it's in the afternoon, it's a trend day. I'm 25 points above the point of control. This is one of those where you can go, oh, well, it's price to value divergence, so I want to fade this, but it's a trend day. You're not going to be successful. And what's going to happen, most likely on a trend day, is that they're going to start balancing on a short time frame. It'll look like this. So you'll have a trend day, and you'll have value down here, and then you're going to think, oh, I want to try to short this, and it's just going to keep going higher, and then eventually somewhere up here, they're going to balance, and they're going to move the volume point of control all the way at the end of the day, and then continue the next day, and you're just going to get run over. So if it's a trend day, do not fade. That's actually one where it feels weird. It feels late in the game to go with it, but yet there's opportunity to still go with that if you can find order flow spikes in that direction. Okay, one more. It's 11:30 p.m. in crude. We have single prints formed in the profile. So far, it's a normal variation higher day. The current point of control is 40 cents below. We're currently trading above the IB range. What's the opportunity? Where are we most likely to get trapped? How can we avoid getting trapped? Well, one would be where are those single prints in the profile? Is that between where I'm trading and where the developing point of control is? Because that could be a mid-session gap, like a double distribution, and that would be hard to fade. So I would need to see lower lows on the 30 minutes if I tried that would eat into those singles, if those singles are in between price to value first. So if that was looking like, here I have an IB and then I spike, and then I've got, some stuff. So I've got singles like this. I would need to see another 30-minute get back in here if the point of control is down here with some decent order flow to believe that the auction was going to like roll back on itself. So that's another one where I could get trapped trying to counter the trade and not have the participants going in the direction that I want to go. So even though you feel like you're waiting to see somebody else take the risk first. Trust me, you'll do so much better if you wait for somebody else to make the move first and then let it confirm and then lean on that. Okay. There are better prices to trade than others considering where value was and is developing. Price to value convergence presents opportunity. Also, price to value divergence represents opportunity. Know which one favors your style. Full disclosure, I am definitely a price to value divergence guy. It feels cleaner to me to trade when those are divergent, but also that's the risk because it's in an impulsive area. If you try too fast to counter it, you're going to get run over. Other traders are better at price to value convergence. Know which one fits you best, and we'll help you along the way. Okay, your homework, just to help aid this, is to identify an example of price to value convergence, identify an example of price to value divergence, and do this in the time frame you seek to be active. So and for most of you, it's going to be during the intraday session. Do this in at least one time frame higher. So if it's intraday, try it on like a daily chart. And then again, answer the question, either at least to yourself, if not to the team, but are you a better trader with price value convergence or price to value divergence? And share that in the Pathway channel via Slack, direct message, or email. Okay, that's module 4, monitoring and executing based on price and value placement. Hope you use this to help you know where are better places to be active. You can set alerts there, let the price come to you, let the move happen, and benefit from that. And we'll see you next time. Peace.